In today's video, we are going to check out one of the most asked companies, and this is NVIDIA Corporation. And since the last inspect, the stock price has fallen a lot. Year to date, we can see a lot of negative numbers. And if you stay to the end of the video, you will get a picture. Do I think the company is overpriced still, or it has came to a point that we should buy it? And if you would like to trade stocks, I recommend using eToro. You can check it out in the link of the description. They are also the sponsor of this video. And if you would like to get the analyzing tool, you will also see it in the description. So as you can see, the past 6 months has been a very, very strong decline for the company, especially the last few months has been the worst for it. The reason is very easy. Last year it has grown a lot. So when there is a little headwinds coming in front of us, the market tends to overreact, as they are also overreacted the buying in last year, in my opinion. So we can see that the price target for the company, and we are on the eToro website, 171. You can get these absolutely free. So if you don't want to deposit money or just to check these data, you can also register to eToro, and you will see a short analysis of the companies from different people, their price targets and their sort of thoughts on the company. It's very good tools to use, and also financial information where you will see that the beta or a risk measure of the company is 2, so it means that it is much higher than the average, let's say around 1-ish. If you compare it to the S&P 500, the 1-year return was 27%. It is much higher than the just the average growth of the S&P 500. The earnings per share is very positive, and the dividend yield is a slight dividend yield right there. The current P/E ratio is 34, and we will see all of this in also the valuation formula. I have plugged in the ticker symbol NVDA, and then you see all the data. So we can see that if we would like to get a little more picture of the current ratios, so just remember, current ratios are showing the price in terms of the market. It is not a valuation formula. It's just showing if you use, for example, net income or earnings per share, and then you just put it next to the price on what ratio the company is currently trading on. So it is not a total measure of what's the real value of the company, but it's a measure of in generally on how the market is currently pricing it. So if we are checking the P ratio in the historical terms, we can see that the company is actually cheap. So the current P is 34, and we can see that the previous years has been much higher. So the P/E ratio tends to come down more aggressively when the company is starting to show slowing growth. We will see if this is actually the picture or not. But currently we can say that in terms of the price to earnings ratio for the past 5 years, we can see that it's actually much cheaper than it used to be. So if we look at the price of free cash flow, that might be a little bit better picture, because it's a more clear sign. We can see that their price to cash flow ratio is also lower, but not as much as the price to earnings ratio. So the price to free cash flow ratio can change if the company reinvests a lot of its free cash flows, which is extremely healthy. There is no issue at all. But I'm just saying that in general, if you look at how much the company has grown in the market capitalization, you can see a tremendous growth in the 2024-2025 fiscal year period, and now the current market cap is about 2.5 trillion US dollars. It can change every day, so it is important to see. And if we look at the analyst opinions, then we can see that there's a huge upside that they are voting for, which is quite normal. So everyone is on a strong buy or a hold position. Some of them are in a strong buy position, and a few of them in the hold position. For honestly, I don't think it really matters. The discounted cash flow model will tell us what exactly I would suggest to do in this case. And if we look at their income statement, their profitability and free cash flows has been growing amazingly. So look at how much profit they are able to make in fiscal year 2025, and the shares outstanding has not changed, so they haven't diluted the investors. They also pay out a little dividend, so everything looks together. They don't have any debt, a lot of cash, so the financial safe haven for this company, I think, is very, very high. But let's go into the actual free cash flow and let's try to put together everything. And for this, we will need the free cash flow of the company, where we can get it. We can get it in the cash flow statement and the free cash flow basis. And we will start with the year 2021 and just copy paste everything from the year 2021, and we will just change the dates on the top. So what are we actually doing is right now is we are taking the free cash flows, we are putting them into the data sets, and we will get an average growth of the free cash flows for the past 5 years, and this will determine how we are going to actually choose the growth rate for the next year's cash flows in terms of this. So let's just swap it very quickly since we started with the years. Remember why it's 2025. Some companies can decide they would like to make their financial statements from September to September, to October. So we can see actually 2025 numbers in this meaning, but it doesn't mean that they got it for the calendar year. It means they got it for their financial year. So we can see that their average growth is about 188% in the past 5 years, and the highest growth is obviously in the last 2 years, and the highest is actually 2025. So 600% is incredible, and you can see that here we are going to project the future free cash flows, and the future free cash flows we will need to discount it back to present value, and for that we are going to use a weighted average cost of capital, and the weighted average cost of capital from an analyst is 19%. Obviously this can change rapidly. I usually just go with the 11%. And this reason is because you can't really mess up with 11%. The WACC can decrease significantly. Also, the average growth rate can decrease significantly. So you should go with a number that you are quite safe with for the next 5 years, and you don't need to be worried about. So in these terms, you will see we have an average growth of 35% for the free cash flows. I think 35 is a little bit high for if you looking how developed already the company is. So I would go with somewhere around 25% and taking back the discount rates to around 9%, and you will receive a share price per NVIDIA or $90 per share. And the reason for that is, as I said, I don't think the company is able to sustainably grow this much as they have done in the past 5 years. Whoever invested in NVIDIA have made great profits. But although I think it is going to be very, very hard to sustainably grow this free cash flow, and therefore I think the stock price should be around this level, using maybe a 10% margin of safety going to the 80s. So we can actually see that the company is not as far from this as we would expect it. So the growth will be very much determined by macroeconomical conditions. So if these tariffs will play in as a negative gamer, then we can see the stock price decreasing to these levels where you can safely say, okay, I can sustain this 5-year level of growth. But you can also see an instance where the growth rate will be negative for 1 year, and then the next years it will be extremely positive. So what I'm saying is, I think you should wait 1 Q or 2 Qs and then see how the performance has been for the company, and then you can make some sort of thoughts on how would be your next step. I am not an NVIDIA investor. I am not looking into buying NVIDIA shares, and this is because of the high volatility in the market and also of the high risk. I would rather choose companies with smaller market caps. And if you like this video, feel free to subscribe to my channel. I really appreciate if you check the description and use one of the links to get these tools. It's super helpful for my work, and also if you subscribe, that also helps me a lot. And feel free to put down the next stock you would like to get analyzed in the comment section, and I will make sure that you will get it. So stay tuned, subscribe. Looking forward to see you in the next video. Goodbye.